Hello everybody, this is Lara with your end of the week video for the trading week ending Friday the 11th of October 2019. For the very short term, I'm expecting a little bit more downward movement to either the 0.382 or 0.618 Fibonacci ratios of the last 5 up. And after that, I'm expecting the upward trend to resume. I've been expecting new all-time highs. Maybe it will come next week, maybe the next week after. But this week we've got a new all-time high from the AD line. Again, it's a really strong bullish signal, supports the main Elliott Wave count. I'm still going to publish an alternate for those of you who are more bearish though, because it seems to make people happy. I don't have a lot of confidence in it. That's okay. This wave count sees the simplest Elliott Wave structure, a 5-wave impulse beginning for this bull market in March 2009. Off to the left of the chart, the last candlestick for November 2014 is the end of cycle 1, and here's the end of cycle 2, 3, 4, and now cycle wave 5 has to complete as a 5-wave motive structure. So far that structure is incomplete. I can't count it 1, 2, 3, 4, 5. That would be a diagonal with a truncated 5th wave, and that is technically possible, but extremely rare. I would not want to publish such a wave count with such a low probability and little to no support from classic technical analysis. When I put cycle waves 1, 2, 3 and 4 in those positions, I then draw an Elliott channel around this bull market, with the first trend line drawn from the end of cycle 1, the last candlestick for November 2014, to cycle 3, and then a parallel copy on the end of cycle 2. And when you do that on a semi-log scale, it perfectly shows where cycle 4 found support. And there's an overshoot for the strongest portion of the third wave of the third wave. This channel looks textbook perfect, adding confidence that the labels of 1, 2, 3 and 4 are in the correct places. And that tells us a couple of important things. As I've just intimated, cycle 5 is incomplete. I would not want to label it over here. The structure is incomplete. And cycle 5 has a limit, because in this instance, cycle 3 is shorter than cycle 1, which means to meet the core Elliott Wave rule stating that cycle 3 can't be the shortest wave within the impulse, cycle 5 may not be longer than equality in length with 3 at this price point. Let's turn our attention now to the structure of cycle 5. It may only subdivide as a 5-wave motive structure. And that means either an impulse or an ending diagonal. This first weekly chart looks at the possibility of an impulse, with so far 1 and 2 complete, and now 3 beginning, showing its subdivisions at higher time frames. That's a really normal behaviour for this market. For the S&P 500, its third waves are most commonly extended. If they don't extend in price, they'll often still extend in time. My target for primary 3 is only for it to reach equality in length with primary 1, but I expect it may be more time consuming and drawn out, showing its second wave corrections within it at the weekly chart level. That would have a really normal look for this market. When primary 3 is over, primary 4 needs to then unfold. It'll probably be a shallow sideways consolidation lasting several weeks, which may not move back into primary 1 price territory. So once the structure of primary wave 3 is complete, I will expect price to not move back below this point here. Within primary 3, no second wave correction may move beyond its start. This is the final invalidation point for the impulse structure of cycle 5. Let's look at this at the daily chart level. From the end of primary 2, this point here. Here's primary 3. The target for it is to just reach equality in length with primary 1, because that fits with the limit for cycle 5. Primary 3 may only be an impulse, and so far intermediate waves 1 and 2 may be complete. Intermediate 3 again may only be an impulse. Again, the target is for it to just reach equality in length with 1. Within intermediate 3, minor 1 and 2 may be complete. minor 3 may only be an impulse, minute 1 and 2 may be complete. There may now be a series of 1, 2, 3 overlapping first and second waves and a third wave at 3 degrees beginning to move higher next week, which means I would expect an all-time high probably next week now. If not next week, then the week after. If minor 2 continues any further, and it could as a double zigzag, then it may not move beyond the start of minor 1 below this invalidation point. At the hourly chart level, here's the end of minor 2. Within minor 3, minute 1 subdivides quite nicely as a 5-wave impulse. Minute 2 looks like it was over here as a zigzag. Minute 3 beginning with minuet 1 probably over at this high. I've looked at different ways of labelling this. On a 5-minute chart, one of our members kindly published a different way of labelling it. When I look at all the little subdivisions at a 5-minute chart level, I think this has got the best fit. So I'm going to label minuet 1 over here and minuet 2 continuing lower. That long upper wick on the daily chart candle, the last daily candlestick, does suggest some more downward movement is fairly likely when markets open on Monday. So let's look for the 0.382 Fibonacci ratio as the first target for minuet 2, and if price keeps falling through that, look for the 0.618 Fibonacci ratio for price to find support for a little pullback when markets open on Monday. I will consider the 0.382 as quite a serious target though, because the strong upward pull now of a third wave at multiple degrees may force minuet 2 to be more shallow than second waves usually are. It may not move beyond the start of 1 below this invalidation point. At the weekly chart level, this wave count is absolutely identical to that first chart up to this point here, and now I'm looking at the other structural possibility for cycle wave 5, an ending diagonal, most likely, if it's going to end within the limit, a contracting ending diagonal, and that is the most common type. But ending diagonals in fifth wave positions, while by no means rare structures, are not nearly as common as impulses, and this wave count does not have as much support from classic technical analysis, which is why it's an alternate. I still consider it to have a fairly low probability. Ending diagonals subdivide 1, 2, 3, 4, 5, and all of the subwaves of an ending diagonal must subdivide as zigzags. So we may have a zigzag complete for 1, and then a zigzag still to move lower for 2. When it's done, a zigzag for 3 must move beyond the end of 1, and then a zigzag for 4 must overlap back into wave 1 price territory, but they may not move beyond the end of 2, and then finally a little zigzag for 5 must move beyond the end of 3. To avoid a truncation, it would most likely end with an overshoot of the 1-3 trend line. Second and fourth waves within diagonals are most commonly, or almost always, quite deep zigzags. The common range is from 0.66 to 0.81, the previous wave. So that gives us our range for primary wave 2. Within that range would sit support at the lower edge of this really important Elliott channel, which I'm drawing on my weekly and daily charts. So this trend line for this idea is a really strong area of support. While the bull market for the S&P remains intact, and there's not enough evidence yet to suggest that it's over, while it still remains intact, I will expect this trend line to offer final support. The rule for 2 of a diagonal is it may not move beyond the start of 1 below this invalidation point. This wave count is the first this wave count is the same as the first weekly chart, except I've moved everything here down 1 degree. The difference is best seen at the monthly chart level. I just want to keep publishing this one every day, just to remind members that although my first weekly chart has the end of a grand supercycle degree first wave coming to an end in another year or so, it doesn't necessarily mean that that has to be the case. If we move the degree of labelling down 1, we could just be looking at a first wave at cycle degree to then be followed by a relatively brief, shallow bear market for cycle 2, to last maybe a year or a little bit more, maybe only a 20-something% correction of cycle 1 in terms of market value, and then another wave up to new all-time highs for a third wave. In other words, my first weekly chart expects an absolutely devastating bear market waiting in the wings, but that's not necessarily the case. This is a much more for the long-term bullish outlook. As the week closes, now we've got two rather bullish long lower wicks from this major low back here. The end of December 2018, we have a series of higher highs and higher lows. We didn't get another all-time high here, but we do still have higher lows and here higher highs. The AD line this week is making new all-time highs, again suggesting that new all-time highs from price are very likely to follow. And if that happens, we will have a series of 3 higher highs and a series of higher lows. And that's the basic definition of an upward trend. That's what price does in a bull market, not in a bear market. And so, until proven otherwise, we have to understand that the bull market does remain intact. We do not have any evidence at this stage of the end of this bull market. This week, with upward movement, volume does not support it. That's okay, because oddly enough, for quite some long time now, volume has been light and declining, yet price has been continuing higher. Look at a monthly chart to see what I mean there. And so for the shorter term, sometimes we're seeing lighter volume and price has been able to rise sustainably for a long time now. I'm talking years. And so in current market conditions, this is not of a concern. I think this is the part of the process of the end of this bull market as it comes to a final end, but it's not there yet. On balance volume bouncing up off weak support this week gives us a weak bullish signal. RSI is neutral. There's some longer term bearish divergence. This can certainly develop further and probably will as this mature bull market finally comes to an end. Topping processes can be long and complicated. ADX is still below 15. That's too low to tell us that there is a trend. MACD is bearish at the weekly chart level. At the daily chart level, I've got a support line here drawn across this low and this low here, and a resistance line possibly about here. Resistance first though, about 3,000. Prices reacted strongly down from there at the end of Friday's session. Friday though was an 80% upward day. I should also have noted in my text analysis actually that I will expect that this gap may be a pattern gap for this small consolidation here. There's 1, 2, 3 gaps in here. Those are pattern gaps. This may be a pattern gap, this may be a breakaway gap from the small consolidation, and so the lower edge of that gap may actually provide support. Friday was an 80% upward day, and that the upward volume was more than 80% of total up-down volume, and advances were more than 80% of total advances and declines. That's what an 80% upward day means. If we see on Monday another 80% upward day, then we'd have 2 back-to-back 80% upward days, and that would be quite a strong bullish signal. From these lows back down here, we've got this 90% downward day, a bounce, another 90% downward day quite quickly after, followed by a 90% operating companies only upward day. And that pattern is typically seen at sustainable market lows, which is why I've been fairly confident for some time that these lows are going to remain intact, and so far they have. If we see another 80% upward day or a 90% upward day, again would have further indication that now this low should be a sustainable low and should remain intact. Resistance held on Friday about 3,000. Resistance can be broken above there, then the next resistance is at these previous highs and then the previous all-time high. Volume actively pushed price higher Thursday and Friday. That's good to see. ADX is now declining, indicating at the daily chart level there's no clear trend. Price is essentially range bound, but it may have just broken out of a small consolidation here. ATR increasing as price falls, essentially starting to flatten off now as price rises. That would be absolutely normal behaviour for this market. On balance volume has made a new all-time high prior to price. That's a very bullish signal back here. This was not an all-time high for price, but it was for on balance volume. On balance volume now giving us a weak bullish signal as it breaks above weak resistance. That supports the idea that we may have a sustainable low down here. RSI in neutral territory, MACD bearish and fully so, stochastics in neutral territory. This week, the AD line has made a slight new all-time high. Price has not done so yet. The AD line also has made a new short-term swing high. Price has not done so yet. I read the AD line as a leading indicator. Where it leads, price usually follows. So this is a very bullish signal and strongly supports the main Elliott Wave count. Market breadth is rising faster than price. Both price and breadth have made new short-term swing highs. Breadth is really close to making a mid-term swing high, but price is a bit further off. So at the weekly chart level, there's a new all-time high from the AD line. At the daily chart level, not quite yet. But the rate at which breadth is rising looks to be a little bit faster than price, and so there is some quite strong bullish support, underlying support from market breadth pushing price higher. That's good to see. Inverted VIX doesn't have any bullish divergence, though it did for Thursday. It doesn't for Friday. Inverted VIX rose for Friday, as did price slightly, but there's no short-term divergence. There is this longer-term divergence. Sorry, not Thursday and Friday, those are the last 2 weeks. The weekly chart shows this longer-term divergence between price and inverted VIX. This is not particularly useful. It has proven so far to not be useful as a timing tool. There's divergence here, yet price made new all-time highs here, and still further divergence from previous all-time highs. This may be part of a long drawn-out topping process, and this could continue for many months more as this bull market, this mature bull market, comes to a final conclusion. The shorter-term picture sees price making a slight new swing high, inverted VIX making a reasonable new swing high. Inverted VIX is rising faster, a little bit faster than price. There's no divergence between these swing highs, but inverted VIX is more above than price is. So this is some quite good bullish support for the rise in price. As price is rising, VIX is showing a normal corresponding decline. This is inverted VIX. So that classic technical analysis still does quite strongly support that main Elliott Wave count. That's all from me at the end of this week with your S&P analysis. I hope that all of our members are having a most awesome weekend.